Hello, and welcome to the Forbes and Square Small Business Virtual Summit, Banking on Your Business, Getting and Keeping Your Financial House in Order. Throughout the event, you can connect with our speakers and each other via Slido. You can do so by selecting the Join the Conversation button, which can be found at the bottom right-hand side of your browser. You can access via your mobile device by scanning the QR code on screen and using the hashtag #ForbesSmallBusiness. Now, please join me in welcoming Maneet Ahuja, Senior Editor, Forbes.
Thank you, Juliana. Hello, everyone. We're so excited to have you join us for this critical discussion. We know that this has been a very challenging year for founders and business owners. An estimated 75% of which have needed to pivot their businesses. Added to that, a reported 70% expect to do so in the next year. That's why we're here today to prepare you for the path ahead. After today, you'll be able to walk away with tangible advice and best business practices to help you capitalize and scale your business. I am so glad that you decided to take the time to be here with us today and hear from our esteemed panel.
Now, please welcome Melissa Bradley, co-founder, Ureeka.
Hi, my name is Melissa Bradley, and I am founder of 1863 Ventures and co-founder of Ureeka, a small business platform dedicated to reduce friction for businesses trying to grow and scale their business. I'm honored to speak to you today about getting and keeping your financial house in order. Now take a deep breath before we get started, because I am a finance major, and I'm really excited by that, because in all the world where everything is changing, 2 + 2 is always 4, 3 + 3 is always 6, and numbers always tell a story that can actually really help you in growing and scaling your business. So there's 3 topics I want to cover today. 1 is getting your accounting basics and getting your whole house in order. 2 is producing and understanding your financial statements. And 3 is seeking capital. And they all go hand in hand. So let's start with accounting basics. Now, I'm sure we all have a phone. We've all got tons of apps. This is the chance to get organized, for you to find the right app for you. I'm not asking anybody to be like me and put all my receipts in one big box. But the first thing is to find a system that works for you, that you're comfortable with, that you have a user experience with, that you find confidence, and it doesn't scare you to be able to keep track of all the money coming in and all the money coming out. So first thing is find a system that will help you keep track of your receipts and help you understand what's going on with your business. The second thing is understanding how money comes in and how money goes out. Now, one way to do that is invoicing. That's one way to guarantee all money to come in. One of the things you'll find that's really important in accounting basics is setting aside time and creating discipline to dedicate to managing your finances. So set aside an hour a week or an hour every other week, nothing really less than that, so that you can actually push invoices out to your customers to guarantee that there's steady cash flow coming into the business. And most importantly, people pay you on time. And in the event that you're finding you have a low cash flow shortage and you need a little bit more money to come in sooner than later, think about providing incentives for people to pay you earlier. The beauty about invoicing is you can give them a 1% or a 2% discount, and hopefully that won't tank the business, but allows them to be incentivized to send money earlier to your company. The other thing I would say in terms of managing money coming in and money going out is that make sure you're accounting for everything. The biggest thing is don't commingle funds. I know we may be out, we may be online ordering something, and the first card we pull out of our pocket is our personal one, and you're going to buy a new computer or some files. Stop and make sure that you're using the business card. If you do use your personal card, make sure you get reimbursed by your business and you put those assets in your account related to your business only. It is really important that you keep track of funding that you spend for yourself and that you spend for your business, because if you don't, you may underestimate the cost of running a business or understate the value of the business because you spend so much stuff with your personal account. The final thing I would say is, we talked about getting paid from other people. You got to pay yourself. Now, you may say my business is not making enough money, but it's about discipline. So you want to have a line item that says salary or CEO draw or something related to that, where you may not get the same amount every single month, but it's in there so that we're accurately tracking that you are getting paid. You may be a contractor because you can't afford payroll services, but you want to make sure that there's an owner's draw or something in there that notes that you deserve to get paid a salary and that you're making a sacrifice on the months that you can't pay it, and that it's clear what you're owed once the money comes in. It's one of the biggest mistakes I see entrepreneurs make, is that they forget to put themselves in the business because they're so busy working on the business. So in terms of accounting basics, 1, get a system. 2, set aside time and discipline to manage your receipts and input things in the system. 3, set up time to make sure that you're getting paid and you want to send all your invoices out, as well as set up a time to pay your bills. 4, make sure that you are in the business, but you're not commingling funds, but you're certainly accounting for your salary because you're probably the most valuable person in the business right now. So that's accounting basics of getting systems in place to be able to track the money. Now, when it gets tracked, how do we know what it's doing? Financial statements. Again, take a deep breath. It's really easy stuff. And it's important for you to understand because financial statements tell a really big story about your business because it is the combination of all your receipts and all your accounting systems and any expenses you have, all the stuff we just talked about that you're working on. That's what goes into making a financial statement. It's important to know that financial statements are not just something that says how much you're making or how much you made or how much you lost. It's so much bigger than that. It talks about the value of the business. It talks about where you have opportunities for growth. It talks about where you need to make cutbacks. It talks about how you're spending the more money and how to make decisions based on that. So financial statements tell a really big story. So there's 3 you need to know: income statement, balance sheet, and cash flow statement. Now let's go through them one by one. The first is an income statement, which is literally all the money coming in and all the money going out. And at the end of the statement, it tells you net profit or net loss. And either one of those are good and bad. It doesn't really matter. It's what it tells you. So it's not about everything has to be green and oh my gosh, everything is red. It just begins to tell you how the business is going. So let's take a look at a statement. Now, it may be overwhelming, but first of all, I wouldn't encourage you to do it on an annualized basis. Although you will produce one, you probably want to stay on top of it monthly. Quarterly is a stretch, but if that's the time you have, that's the time you have. And it's really just a way to give you a snapshot of how much money the business is making or losing at any moment in time, which is why if you happen to have a loss one month, it's okay because you'll probably make it up the next. And some businesses just naturally work in cycles. But an income statement literally tells you how much money the business has at any moment in time to reinvest in itself or use to pay other things, which is going to be important when you're seeking capital. The next statement is a balance sheet. And the balance sheet literally tells you the net worth of the business. It's all of the assets over all of the liabilities. Now, let's take a look at the statement. Let me be honest. When I was in accounting, I could never get these things to balance. I would throw everything into retained earnings. So the beauty is if you get an app or a system, it'll do all of that for you. But a balance sheet is really important because it talks about the net worth in the business and how much cash they have access to in case there needs to be an equipment purchase, in case there needs to be a repayment on a loan, anything like that. So it's really important that you understand the balance sheet. And the last one is a cash flow statement. Now, this is probably the one you're going to spend the most time on because it literally tells you how the company is doing, ideally week over week if you want, or month over month, but nothing longer than that because it tells you where all the money is coming in and how it's all going out. And that's important because some of the money may be coming in through sales, some of it may be coming in through consultants, some of it may be coming in through products, some of it may be coming in through services. So a cash flow statement really lets you understand what's selling and what's doing well and where maybe it's not, and where are my biggest expenses, which is an opportunity, and where I may need to cut moving forward. And so when you take a look at a cash flow statement, again, they probably all at this point looking very similar to you, but it's all the cash in that really denotes where it's coming from and how it's being generated, which is going to be good to know in the future, and then where it's all going. And the point again of this statement is to let you know on a monthly or quarterly basis, where do you have room to invest and where may you find some shortfalls. Now, as I said, all 3 statements together tell a really powerful story, particularly if you're seeking capital, because if you have an erratic cash flow because you're a cyclical business and it may not be coming in, so sure, you may not be able to pay every single month. But if you have, I look at your balance sheet and you've got a nice set of reserves on the side, then I feel better about some of that cash flow smoothing and I feel good that I'll actually get repaid. When you also look at the income statement, it gives you a chance to see where you need to begin to make tweaks in order to show some kind of profit and be able to manage losses. And then if you go and see that you have a net loss, you go to your cash flow statement, you begin to see where you need to tighten up on the money going out of the business. But all in all, the statements together give a real picture of your financial health of running the business. Now, you may say, why is all this important? Well, it's extremely important for one, as you as a CEO, to make sure you're making the right decisions about managing your finances, but it's even more important when you're seeking capital. So let's talk about raising money. Now, when we talk about raising money, I want to focus on debt. I want to focus on 3 types of loans: an SBA loan, which is a small business administration loan, a term loan, and a revenue share loan. Now, let's go through each of those. A small business administration loan is guaranteed by the government, which is great. You can get it through any participating banks or community development financial institutions, also known as CDFIs. So you don't go call the government, but you ask banks that you're working with or banks that you know, do you offer SBA loans? And the beauty is they're guaranteed, and they come in a range of sizes for people who have revenue under 30,000 to people who have revenue over $1 million. A term loan is a type of loan that you want to be mindful of, that where you'll look at your cash flow statement and say, if I take out a term loan, it means I have the same exact fixed payment every single month. Do my cash flow statements allow me to cover that? So a term loan is literally a loan over a period of time, 3 years, 5 years, and it's the same exact payment every single month, which if you have great cash flow and you're not running on cycles could be amazing, because you could actually possibly prepay early. But if you're in a cyclical business, then that may not be the best way and the best thing for you to think about. So I have one more option for you. Revenue share loan. For businesses that operate on cycles or don't have steady cash flows, but have some reserves in their balance sheet just in case something happens, a revenue share loan again, 3 years, 5 years, but allows you to borrow a set of money and repay it based on a fixed interest rate that is calculated based on how much money you make net every single month. So if 1 month you make net 10,000 and another month you make net 3,000, instead of having that fixed payment, I may take 7% of each of those. And so the first month I may take $700, the next time I may take 210, and that's okay because I've built that into the model. And so if we take a look at these loans a little bit deeper, as you can see, the revenue share loan is great because it doesn't require personal guarantees. It's typically aligned with the incentives and you of management and what you're trying to cover and what you're trying to get out of this process, which is not administering any kind of challenges or burdens to the business, but allowing it to operate based on its current cash flow. And we look at basically financial performance and your ability to repay. Now, a term loan, you probably could get a little bit more money, $25,000 to $1 million. But again, you got to have the financials that say, I can actually pay this back over a steady period of time. And of course, the beauty about the SBA is that it is indeed guaranteed by the government. And particularly if you're a person of color, a woman, or a veteran, there's actually special programs just for you that you could probably take advantage of that could actually lower the cost of those loans. It's a good thing to keep in mind the different types of loans that are out there. Now, one we've probably heard a lot about is the Paycheck Protection Program. And we know that there's some money left. And this is really important if you have people who are on payroll. And the beauty is if you have your accounting house in order, now you've got your financial statements, it can be pretty easy to figure out how much you're spending in payroll. So the Paycheck Protection Program, pretty simple application to fill out. But as I mentioned, and it is in the name, it's all about payroll. And so you have to be able to tell us what are your average monthly payroll costs. Now that can be easy because now you have a way to track full-time staff, part-time staff, consultants, contractors, you name it. The only employees that will not qualify, or contractors who will not qualify for the Paycheck Protection Program, is anybody making over $100,000. But if you have anybody who's making under that, then you want to be able to make sure they're included. And if that's you, that's why all the more it's important that the draw or your salary is in there, even if you're not regularly paid for, because it is still an expense of the business. Now, in addition to having that all completed by looking at your statements, you have to complete the application, 2 to 3 pages, not hard. You have to have proof of payroll. So if you're outsourcing it or you have an accountant or using your bank, easy enough to prove. We want to make sure you're actually incorporated. So we want some kind of certificate from your state where you operate that you're allowed to do business. You got to be able to share all owners who are over 20%. You want to make sure you have an email address so they can contact you if questions. And certainly by all means, you want to include your banking information so they can send you the money. So don't be daunted by all that stuff you read. Pretty straightforward process, particularly if you have your accounting house in order. Now, when we think about other things that banks may be thinking about, for example, if you don't have people on staff and you don't have payroll, then you can go think about a loan, an SBA loan, a term loan, or a revenue share loan. And there's 3 things that banks care about. One is the loan. What is the purpose of the loan? Is it something that's actually going to generate more revenue? Is because they don't want to give you a loan if it's to pay off past debt. The second thing is how much are you asking for? And is it reasonable based on what you're making? And then finally, what are the repayment terms, which we'll be able to see what you can actually manage from your financial statements. And the second thing to look at is financial statements. They're looking at your balance sheet to see in case you have to miss a payment because of cash flow, or there's some reserves there you can pay. They look at cash flow to figure out what debt burden can you bear on a monthly basis. And if not on a monthly basis, then maybe you're ready for a rev share. So all of those statements come into play. And believe it or not, there's still lenders out there who care about your character. They want to talk to you. They want to see you on video. They want to understand your vision and mission for the business. They want to hear your passion behind this, and they want to assess your ability to actually run the business. So those are three things to remember when you're trying to get a loan. Now, it's important to know what worries banks. Frequent excesses or late payments is extremely going to make them scared. If you don't have financial statements enough, that's going to make them scared. And if you haven't really been able to articulate how you're going to pay the money back, then they're probably going to go running for the hills. So it's important to understand what worries banks. But if you have your accounting house in order and you've got your statements and they're up to date and they're year to date and you can talk about some of your decisions behind them, then most banks will not be worried. Now, what happens when you walk out the door? I'm sharing this FYI. Don't panic. You don't need to memorize this, but I do think it's important that once you leave your application, you hang up the phone, you get off video, or you walk out the door, what are bankers doing? Well, they're doing something called underwriting, which means, can you afford to pay me back? And they're looking at a few things, and we call it CAMEL. They're looking at capital, how much money is in the business, how much has been invested, how has it been spent and utilized. They look at asset quality, look at your balance sheet. Are you holding things that are old and decrepit, or do you have assets that are relevant and new and worth something? They look at the team. Believe it or not, again, they care about who you are and what's your vision for the company. They look at earnings and how stable they are and where there have been some challenges, and looking at your income statement and your cash flow statement. And they look at liquidity, which is your balance sheet, that if indeed they need to get back to you and say, look, we're going to call your loan earlier, you need to pay us back sooner, they can look and see if your balance sheet allows you to have any liquidity or actually access to retained earnings in the business. So you begin to see how all of this comes together. So I hope that this has been helpful to you of understanding how to start getting your house in order with some basic accounting systems and processes and setting aside time and discipline. We hope you better understand financial statements so that when you see them, you don't just see a bunch of garbled numbers, but you see a story around growth and scale and potential and credibility. And the last thing is, as you go out and think about seeking capital, you now have some options of who to go to, but more importantly, you understand what type of loan is going to be best for you, and you understand what they're going to be thinking about when they're talking to you.
As we move into our panel conversation, we want to remind you, you can ask questions of our panelists in Slido. Now joining Melissa, please welcome Mandela Dixon, founder and CEO, Founder Gym. Carla Harris, Vice Chairman and Managing Director, Morgan Stanley, and moderator Maneet Ahuja, Senior Editor, Forbes.
Well, thank you, Juliana. And first, Melissa, thank you so much for that phenomenal presentation. It was super informative. To get started with our panel, I wanted to ask you first what some of the foundational aspects business owners need to have in place before they're ready to secure outside funding.
So there's a couple of things. So first, just glad to be here and amongst such amazing women on this Giving Tuesday. I'm honored. I think there's a couple of things that business owners want to make sure they understand. One is what they have experienced and what it's taken to get their business where they are from an accounting perspective. So having their house in order, getting their statements that I talked about. The second is finance, which is understanding where they want to go and having those projections and sense of cost, and more importantly, how their life has changed, how their expenses have changed since COVID and everything else that's going on in the world. And then the third thing, finally, I'll say, we always say the C's. Carla knows. Carla is one of those amazing C's. But, the C's is also confidence, right? One thing I always say is that I was a finance major, partly because I could never get retained earnings in my balance sheet to balance. But the other piece was that the one thing that doesn't change are numbers. 1 + 1 is always 2. 3 × 3 is always 9. American history changes. Politics changes. Policy changes. So numbers don't change. So I would say really having confidence that it's your business and you actually know what's happening and what's going on. And there is no better person to articulate your needs and your potential than yourself.
That's a good point. And like you said, you are a finance major. So for the audience that may have a general idea, can you help us crystallize what are the fundamental differences between accounting and finance?
Yeah, so the biggest thing is that accounting is what you've done, right? It is accurately capturing your past performance in terms of revenue and expenses. And as I alluded earlier, that balance sheet that you need to get balanced, I never did in my accounting 101 course. What I like about finance is around projections. It's really laying out and kind of putting the means behind whatever model and strategy you have moving your business forward. So accounting is looking through the rearview mirror. Finance is looking forward and creating models that demonstrate your potential as based on your past and where you want to go moving forward.
Mhm. And one quick follow-up. At the outset, and this is for the whole panel, but Melissa, we can start with you. At the outset, we know that the majority of founders are bootstrapping their businesses. What are best practices when it comes to self-funding? And then we'll go to Mandela after.
Sure. I mean, I think before we even get into best practices, I want to say the one important thing that I say over and over again, and hopefully Mandela and Carla will support me, which is keep track of what you put in the business. It is too often when entrepreneurs go on to get venture capital, go get a loan. The question is, what have you already invested in the business? And so I don't care if you keep it on a piece of paper, if you keep it in a Google Doc. The first thing is keep track of any and all money that you put in. That includes you went to the store or you ordered on Amazon some folders, to the computers, to running a social media campaign. I think that's the biggest challenge that we find is that entrepreneurs underestimate the value that they have already contributed to their own business. So I'd say the biggest thing is just keep track of your financing. And then the other piece, which I alluded to in the video, is having, being in venture, particularly, and I know Mandela can relate to this, there's always that question of what's the valuation and how do I stay on the cap table? And I know she'll get into that. But part of that is how you can show evidence that you are making an investment in the company, not just what you put in, but via salary. So whether you can afford it or not, you should always include a line for your salary or at least a draw so that when time comes that you can actually afford to pay yourself, you can do so without any question from anybody else. It can be listed as a payable. That's okay. But I think too often, if we don't pay it, we don't count it. And the beauty about this is you have to count everything. So there's always an accurate valuation of what your business is and what your value is so that as you go through loans, lending, venture, whatever the case may be, you can track that. And even if you're doing a self-funding campaign, you're doing a Kickstarter or I Fund Women or Founders of Color or something like that, you still want to be able to show what you have put into the business. So dare I say, accounting, keeping your books in order, really spending time on your finances, and most importantly, making sure you're tracking what you have contributed to your business so that no one can take that away from you.
Those are all great points. Mandela, what are some of the best practices when it comes to self-funding at the outset?
Well, I think either you're going to get the money from yourself or from somebody else. And I think it's really, really important to understand the advantages and the disadvantages of being your very first investor. And so working with the communities of entrepreneurs I do, who identify as underrepresented, meaning there are less of them operating businesses than their representation in the overall population, I find that they have challenges raising capital from angel investors, accelerators, venture capitalists, getting bank loans. So oftentimes, by a result of the challenges of getting external capital, they are forced to be their very first investor, which means bootstrapping. And so what I recommend for people is if you are employed right now by another company, what are you doing to automate savings towards your own dreams, right? I think sometimes there's this mentality of entitlement, feeling like other people outside of you are going to believe in your dreams more than you do, are going to want to see you succeed more than you do. And I oftentimes am pretty blunt with our entrepreneurs in that it's your dream. And so you really do need to put skin in the game first and foremost. And so what are you doing with the resources that you currently have to fund those dreams? So we call it Founders Piggy Bank. And literally, I give them platforms like Astra, which is a great savings automation platform to literally siphon off a percentage of your biweekly pay into another account that gains interest and let that be your first angel investment. I think too often we're looking outside of ourselves for the answers when really some of those answers can be found within our own kind of financial systems already. And then there's friends and family. I can talk about angel investors, but I think I'm going to get into that later. So I'll stop there. I just really want to challenge people. Why aren't you your first investor?
That's a really good transition to the next question. So this question is for the whole group, but Carla, I'll start with you. Something that came up in our discussion last week, and I hear all the time from business owners, is that there's a very real fear of money and lack of management skills for many folks out there. What guidance do you have to help them get comfortable?
Yes, I would tell you that you should start to get comfortable with money and understand, as Mandela said in our prep call, your own relationship with money. Because I will tell you that people are watching you, even when you don't know that they're watching you, and they want to understand whether or not you're going to be a good steward of their money. So I actually want to take it all the way back, Maneet, to integrate something that Melissa and Mandela said. You have to be careful around how people are consuming you and how they're watching you with money. If you're one of those people that say, I want to start my own business, but your friends and family are watching you with real expensive shoes and really expensive bags and all the things that you're doing, that is also sending a different signal around how you care about money. So obviously, you need to be careful about how you show up. You should not only keep track, as Melissa said, about what you put in the business, but you should be keeping meticulous track as to how much money is spent on the business, period. Because the last thing you want to do is ask somebody for money and they say, well, give me a sense of your expenses. And you're standing there in front of them estimating that. It's
Right.
easy to teach yourself about money, and that you can take an online course about money. You can read about money. You can talk to a friend who seems to be a good steward with their money. So there's lots of ways to get comfortable. I mean, one of my first things that I did, to be honest with you, Maneet, was talk to another friend who was a trader at a competitive investment bank. I knew about money. I thought I respected money, but she happened to be talking to me about 401ks and the free money that the companies were giving out then they used to match. Well, if you didn't know anything about that before you started this business and coming from where I came from, I didn't know anything about that. That was my first aha moment. So nobody teaches you those kinds of things, but I leveraged a network, somebody who was just close to me, and asked the question. So that's an easy way for you to start gathering knowledge about money and what you can do about the money. The last thing I'm going to say is that you need to understand before you start your business, the difference between your needs and your wants. I hate to get that basic, but you'd be surprised how many people can't save money the way Mandela suggested because they don't think they have the money to save. And I normally tell entrepreneurs, before you start your business, have at least a year's worth of capital if nobody buys anything from your company. Because I've seen too many businesses start the business, they get right there, we're at the 12-month mark, and they have to shut down the doors because they don't have enough capital to keep going. So ideally, you want enough capital to operate for a year if you don't get one sale. Now, Melissa might say, well, Carla, that's pretty conservative. And I will argue that it probably is, but it's better to be safe versus sorry. The wing and the prayer is not the way you want to start your business. And I'm a pretty spiritual person, number one. And number two, as the great philosopher Mike Tyson said, hope is not a strategy. You won't hope somebody come in and give you money. No, you want to show that you put in money yourself, that you are a good steward of this money, that you have planned it out, that you understand finances because you have projected what you might need for the next 3 months because you are clear on what your expenses are for the business.
Mm-hmm. So do you suggest that if possible, people don't even start a new business venture unless they have 12 to 18 months of runway in the bank?
That is my best advice. Now, I understand that most people don't do that because they're in a hurry to start the business. And again, you should check what are your motivations for starting a business. You should not be running from something. You should be running to something is the macro point there. But 12 to 18 months, you got a good shot of A, being able to survive, B, being able to attract other capital because people see that you are operating your business, notwithstanding whatever kind of economy it happens to be. Number three, you'll be able to articulate your plan and why you are the natural owner of this business and why they should invest in you. And having those narratives tight are going to be important when you try to attract somebody else's money. So while you are doing all of that, if you have 12 to 18 months of money to run on your own, that'll hold you in good stead.
That's a great point. Mandela, you said a line I really loved on our prep call. You said money is oxygen for a business. You said it a couple times, and you outlined 3 key steps to mastering money as an entrepreneur in your Founder Gym Masterclass. There's money mindset, money types, and money discipline. Can you walk us through that and how it sets the right foundation for growing a business?
Yes, yes. Listen, I am so excited by this conversation. I'm taking notes here on Carla and Melissa. So I really hope everyone is locked in right now. Turn off your phone, close out Twitter. Please, please, please. This message is not delivered enough specifically from women of color leaders. And I know that people listen to who they relate to. So please lock in and listen to this conversation. I think one of the things I just really want to emphasize before I go into like money mindset, money types, and money disciplines is like, many people from underrepresented communities in the business space did not inherit a money manual and I should say that differently. Everybody inherited a money manual. How well that money manual serves you is up for debate. And I think part of this is we have to just come to the awareness that, and I'm not talking about something you can physically hold, I'm talking about the program between your two ears from all of the inputs you digested as a child. Money doesn't grow on trees. Money is for rich and greedy people. Money is this. I don't have money. Arguing over money. I mean, that's very much resembling the family I grew up in. I don't know about the other leaders on this call, but I think part of it is just, number one, recognize that you've been programmed, and you really have to take a step back and ask yourself, how is this program serving me? Is it producing the life I want? Is it producing the amount of zeros I want in my bank account? Is it producing the amount of comfort and confidence I have around money? If it's not, it is time to update your manual. Rip out the pages that no longer serve you, make an addendum to some things, put new pages in there. But you just first have to recognize that we've all been programmed, consciously or unconsciously, around money. And if you want to change the results of your life, you really have to first reprogram yourself. So that's in relation to like money mindset. The other thing that we cover in our Founder Gym Money Magnet program is around money types. And I know today we're going to talk about bank loans. I'm going to talk about angel investing, accelerator programs, equity crowdfunding, regular crowdfunding, scout programs. I mean, there are many sources of capital. But one thing that I also try to educate our founders with is that each of these types of capital is like traveling to a different country. And with these different countries come different languages, different norms, different traditions, and cultural expectations. And if you do not take the time to stop and study these countries you are trying to go and get money from, your pitch, your presentation will fall short. Another thing I would say in relation to the discipline part of it is that building up and strengthening your money management muscle is very much the same way you would train up any part of your body or psychology for improvement. If you are trying to increase muscle mass, right, you may want to have a daily habit of doing 10 push-ups to start. If you want to lose weight, you may want to actually look at the calories and the other macro and micronutrients you're consuming to have an audit of what you are actually ingesting. And if you want to change the results of it, how are you changing the inputs? The same thing applies to money, is that if you don't have the daily disciplines that Melissa was outlining in her presentation around tracking your numbers, looking at money in, money out, how are you optimizing for tax season, all of these things, then you can't just expect to one day poof and become a money management master. It just doesn't happen that way. And to Carla's point, I thought Carla brought up something really powerful, is that the aha moment for her was looking to a peer in her circle and asking a question. Literally being vulnerable enough to say, I don't know this. You seem to know something I don't. Can you tell me more about this? And I think one of the biggest impediments to people like really mastering money is vulnerability and being willing to talk about what they don't know about money and asking for help. So that's just some of the things that we cover.
That's great. So great job. Melissa, there's so many funding sources out there for small business owners, and you walk through some of them in your presentation. It can be overwhelming, to say the least. How should one start reviewing and deciding which funding sources are best, whether it's a term loan or equity or an RBF? Can you walk us through some of that decision-making process? And then to Mandela's point, there's a variety of options from angel investing to crowdsourcing. So let's start with you, Melissa, and then go to Mandela.
So first, I just want to say, I want to echo Mandela, like this is the best panel ever. As a finance geek, I'm loving it. And I love the fact that the analogy of going to different countries. So I'm going to stick with that. So if you're going to travel outside the country, particularly during COVID, you're going to do your research. So the first thing I would say is do your research. All those options, angel groups, equity investors, loans, whether they're revenue-based or royalty or term loans, those all come from different sources. And to Mandela's point, they all speak a different language. And I learned very early on in working with a lot of young women to demystify their fear of money. It was less about the fact they couldn't count. It was they didn't understand what they were saying. They didn't understand the terms. And just want to, as always, applaud Carla. They were afraid to ask. I mean, they were just paralyzed because they felt like their ability to know numbers reflected their value in the world. And let me just say, wrong answer, right? Money is a means. It does not define you. It does not make you. And so we've got to get comfortable and understand, just like we ask help if our car pulls over to the side of the road, we need to ask help if we need to manage our money. I think so. One is just research all those options. I'll do a very quick overview, but I think, when you're thinking about a loan, whether it's a term loan where you have to pay it back consistently, or if it's a revenue-based financing loan where it's a percentage of your cash flows on a monthly or quarterly basis, the first thing is you got to understand what money you have to work with. And so you've really got to look at your books in the past and really sit down and be honest with yourself. And as I said in the video, don't jump to the bottom line, because that is not an indicator of your success or your ability to be successful. It is just a pure indicator of what happened in that moment in time. So you really want to figure out, can I afford to pay back this loan? Because the worst thing you do is don't pay it back, because not only have you messed up your business, you've now messed up your personal credit and any chance for you to pivot and try to do something else. So I think loans are great if you really have a handle on your cash flow. You see that there's some positive cash flow on a month by month or quarterly basis. You have the ability to repay over time, and that you're mindful that whatever that duration is of the loan, whether it's 3 years or 5 years, your cash flow matches your ability to repay. I'll dive into equity for a second, and then I'm going to leave it because I know Mandela is probably going to talk about that. But if you're looking at angel investing, or you're looking at venture capitalists who are doing investing, and I have the privilege to be both, the biggest thing we're looking at, as you can tell by Silicon Valley, for better or for worse, is not how much money I'm going to make immediately, but what do I think the value of this company is going to be over time, which means you've got to first be really honest and realistic of what's your market potential. I love those little target graphs where this is the market, it's $1 billion, and I'm going to get 100 million. I hope you do. But the reality of that happening in the first 18 to 24 months is almost 0 to 0. And so I think you really want to be realistic is the first thing, because those investors are looking for a 5 to 7 to 10 year significant growth of 10x, 20x, at minimum, nothing less than 7. And so therefore you have to make sure that you have the right company. And what I always say, excuse me, to the entrepreneurs I work with, is that the first thing is you have to decide, what kind of company do you want? Do you want a revenue-driven company, or do you want a growth company? If you want a revenue-driven company, then loans are the best way, because you know that you're churning out capital, you're able to pay that back, but also drive the business forward. If you feel like this is a business that's more around growth and it's going to take some time when you're first learning how to ride your bike and you got to get some training wheels, you need some help and some support, this is it. But at some point in time, you know that J curve is going to start to go up, or that curve around profitability is going to go up. And this is the time for you to be involved with those kind of investors, because regardless of whether it's a lender or an investor, let's be clear about 3 things. They both want their money back. They do have risk. It may be a little higher in age, but they are concerned about risk, and they really can't afford to lose it all. No matter what we say about these big banks, no matter what we say about venture capitalists, they really can't afford to lose it all. And then the third thing is, but everybody wants you to win, right? Nobody's out to get you. And so I do think that this cannot be a combative sport, right? Understanding your numbers should be something that you find comfort in, that you find joy in, but most importantly, you're willing to get the lessons. What I say is that your financial statements are nothing but a dashboard of where you can drive strategy, where you can prove personnel or marketing opportunities, and where you can expand your audiences. But it is not something that says you're horrible, you're bad, which, to Mandela's point, I grew up every other day. Money doesn't grow on trees. I got it. So I do think we've got to get out of this psychology that the statements don't define you, but it's an opportunity to define the path for your business moving forward.
So really, it's also about the transparency, right? Like, not necessarily feeling like you need to hide your the financial reality from potential investors, but showing them that there's a thought process behind it.
That's true. And I also think we should be mindful, right, that putting angel investors aside, because there is a definition that allows them to have a certain asset level to participate. I know that many first-time venture capitalists, they're not sitting on millions of dollars. So in many cases, they're in the same boat with you. And so I think it's not just transparency, but it's truth telling. It's being honest with the world as digital as it is. Somebody's going to pull your credit report. Somebody's going to ask some friends. Somebody's going to ask for your financial. It's going to come out regardless. So be proactive in sharing your story. And to Mandela's point, take this opportunity to change the pages in that book and create a new chapter for yourself in being able to say, look, I have no idea what you're talking about. You can say to a venture capitalist, I have no idea when you start talking to me about convertible, pari passu. I don't know. And it's okay. No one is going to judge you. But to Mandela's point and to Carla's point, I think particularly for women and certainly for entrepreneurs of color, there is such a stigma that we have about, one, admitting things we don't know, and two, being vulnerable, because we're told you have to be 150% better at minimum to be able to move forward. And none of these things make you a bad person. And none of these questions or inquiries make you less valuable. They actually show strength and that you want to get it right and that you are a good steward of their money, as Carla said, and you'll be a good partner because you'll be honest and transparent. When something goes off the rails with the business, they don't have to worry like, what is she doing over there? And I hope everything is okay.
Yeah, and Maneet, if I can just add, the more comfort you demonstrate in being able to talk about the money and your numbers, the more credibility you will have when you're sitting in front of that prospective investor. You cannot know something else about your business, but if you can articulate something about the numbers, it gives you instant credibility. Now, part of that is because of their own stereotypes about who you might be as a person of color and as a woman. So you really blow them away when you're able to talk about the numbers and be conversant around that. But also, it sends a message that if nothing else, you understand that part of the business and that you will, again, do well with the money that they want to give you. So it is worth taking the time to ask the questions. And one last thing I'm going to say, because I know you want to go to Mandela, there's really no excuse today for not knowing. No one can really say, I don't know why, I didn't know where to go. There are too many people out here now extending a hand, saying, I'm willing to sit down with you for 15 minutes. I'm willing to walk you through this, or point you to a book, or give you a resource. Or if I cannot do it, I make an introduction to somebody else who might be able to do it. I would argue that 20 years ago, I give it to you. It was harder to find all of these resources. But now, even a panel like this, where you get the three of us together and it's for public consumption, that didn't exist 20 years ago. So there's really no excuse now for not being able to get some of that basic knowledge that will then lead to the next door and the next door, that will get you conversant about your own money and about your company's money.
You're so right. So Mandela, I want to quickly go to you, but we have a huge influx of audience questions. So after that, I think we're going to pivot over to that, if you don't mind.
Yeah, let's give the people what they came for. And hashtag no excuses. Come on, Carla. All right, what's the question, Maneet?
Oh, about the other sources of capital, from angel to crowdsourcing. If you could give us a little bit of a quick overview. I know that's a tall order within the amount of time we have, but just a little bit of a quick overview so people know what some of the options are and what makes sense when.
Sure. I think that again, as somebody who did not major in finance, I majored in education. I was a teacher, a sixth grade teacher prior to becoming an entrepreneur and entering the world of Silicon Valley. So when I talk about my distance traveled in this conversation, I have come a long way. So I'm going to break it down like I would break it down for a sixth grader, is that I look at it into the sources of capital of, will I owe this group more money? Or will I not? And so I strongly recommend you may want to entertain the sources of capital where you may not owe that group or that person additional capital afterwards, like interest or equity, et cetera. So those sources of non-dilutive capital are, say, pitch competitions. Say it could be contests. They could be crowdfunding, like on Indiegogo, where you are getting capital, but you don't necessarily owe the people who gave you capital something. Now there's the other bucket where if you take their money, you definitely owe them something. Mm-hmm. So when it comes to venture capital, and to Melissa's point, if you have the intention of building a business as quickly, as big as possible, leveraging the tool called technology to do so, then you may be better positioned to raise venture capital. Venture capital is a tool. I call it a cheat code. It's basically using money that your business did not earn from revenue. You basically have to use that money to pay for for staff, pay for equipment, pay for software, pay for all these things you otherwise couldn't afford, so you can go faster than your competition and get more of the market share. It's a cheat code. So if you choose to build a business as big, as fast as possible, utilizing the tool of technology, here are your options. You have angel investors. Angel investors, like Melissa was saying, they meet certain thresholds of personal capital, right? So it might be 200K for an individual, might be 300K collectively as a partnership, and then there could be $1 million in assets. You can Google it, but if there are angel investors, really they're making their choice based off of their personal investment thesis or their personal preference. So I usually say you might want to start there because they do not work for an employer. When Melissa was talking about how a lot of venture capitalists aren't millionaires themselves or don't have all this money themselves to deploy, it's 1,000% true. Venture capitalists usually work for people called LPs, limited partners. They get money from LPs to then deploy into your company. And if you fundamentally don't understand that, you won't be able to speak the language of a VC. Because when you are pitching a venture capitalist, what they are assessing in their mind, I'm just going to give it to you straight, is, will this company help return the fund? Right? And so what's the fund? Well, the fund was the amount of money they got from their LPs. And if your company is not going to have multiples of a return within a 5 to 10 year time period, that may be one of the reasons why they're not investing. So again, a lot of what we teach at Founder Gym is the history of venture capital. What is it? Because if you don't understand this game, it's like LeBron signing up to play against Serena in Wimbledon. He will fail every time because he's been trained in a different sport. If you've been trained in small business or lifestyle business and you're now trying to play the game of a VC-backed tech startup, it's a different game. And you need to take the time, like we said, research, understand the rules so that you can basically play the rules to win. The last things I'll say is another thing that's come out, more so fairly recently, is scout programs. So scout programs are basically, they don't work for the venture capital firm, but the venture capital firm gives them money, just like angel investors would use their own money to make investing decisions. And there are many of these types of people out there. But long story short, if you are raising capital from an angel investor, a scout, an accelerator, a pre-seed VC firm, a seed, guess what? It's all the same. They are buying equity in your company. It's not free money. It's not free money. They have expectations and strings attached with what you're going to accomplish. So I just think that that's one of the most fundamental things people don't understand is you're actually selling equity in your company, and equity is ownership in your company. So no longer are you the sole decision maker, but you actually are involving a team of investors and other stakeholders on your cap table to help drive the direction of your company. I can go on and on. I'm going to stop there.
I just want to double up though on something Mandela said, because I think too often, particularly for entrepreneurs of color, we think that venture capital is the end all be all. And we should just say that that is for a very small percentage of businesses that exist. And you're not a bad person if you don't qualify for it. But I'm hypersensitive, as I've seen many a cap table in my day, where by the time that third round of funding goes, the CEO, who may be a Black woman, is no longer on the cap table in any meaningful way. And so I'm not being disparaging against venture capital, but I just want people to really understand that you're giving a piece of your company, and not just control, but ultimate wealth creation. And so I just say, go back to some of the basics that Carla was talking about and saying, what is your own investment thesis? What is your business thesis? Why are you even starting this business? Is it because you want to create jobs? Is it because you want to become wealthy? Is it because you want to be the next, rest in peace, Tony Hsieh? Whatever it is, because all of those require a different orientation of your own mindset and a different type of fuel, which is investment capital. And you better know, don't think you can be on Shark Tank and you ultimately don't want to give away any of your company. So I just want to echo again, Mandela says, do your homework, do your research before you start venturing out and end up in the wrong place at the wrong time.
But Melissa, that's something to understand. And I know you want to get the questions, Maneet, because people don't understand that for businesses of color, very often you are actually going to more people to raise the same amount of money that folks, who are not of color raise. And so as a result, by the time you get to your third or fourth round, you might have a negligible amount. So please, before you go out to do that and you give away any equity, call Maneet, call Melissa, call me, call Mandela, call somebody to get some advice around that, because you are probably giving giving away too much of your business. And that will be a problem if you are successful and a VC or a strategic investor want to come in and there's not enough for them to buy. So I'll stop there, Maneet.
Well, thank you guys for that breakdown. We have about 7 minutes left and dozens of audience questions. So this is going to be a speed round to kind of get through some of those. Let's jump in. Are there any grants for small business owners? I do not have the capital to support a loan.
Tons. Dare I say, unfortunately, post George Floyd, there are tons of them. At Ureeka, we just gave out $100 million to 15,000 entrepreneurs in 3 months. WeWork, Facebook, Salesforce, you name it. So I would say, get on some of the listservs, sign up for Mandela, follow all of us on Twitter. There's tons of programs that corporations are coming to the table to give out money to make sure, particularly advancing women and entrepreneurs of color.
Okay, next question. When doing a line item for founder or CEO pay, how do you evaluate how much you should be paying yourself?
Yes, I'll go there. First of all, you can go to salary.com, glassdoor.com, mercer.com, and you can also speak to an executive recruiter and say, hey, someone in this industry with this amount of experience, what does a CEO look like in general? And then what does a CEO look like of a small business, medium business, or Fortune 100 business? So you can kind of get a sense of what the playing field should look like. And that's the number that you should put there. You can't just all of a sudden say, I'm a CEO, I should have $1 million, and you've never been a CEO at all, and it's your first time starting your business. So you do have to be reasonable around that. But going to these outside sources will give you a sense of where you should be. And then now you can discount from there for a business that's just starting right out of the gate, what makes most sense. And again, talking to the network, people will tell you what general startup CEO pay looks like after the Series A, after the Series B, for example.
Okay, got it. What if your previous job didn't allow you to save? How do you know if you will have sales if you're just starting out without having money for ads?
Having money for ads. I think there's a concept called MVP, your minimal viable product. And I really think a lot of people over-engineer their first product and or service. And so my challenge to you who's asking this wonderful question is, what is the bare minimum that you would have to do to prove out your initial hypothesis? And maybe your initial hypothesis is around money. So what's the bare minimum that you would have to do to make that amount of money? Because I can't tell you how many times I've seen a t-shirt business and I go into their portal, their Shopify store, and they got like 50 different options and they're trying to sell all these 50 different shirts. And instead, if you really focus on making 1 or 2 amazing shirts, like out of this world, and marketing them on free tools like social media, right? Then how much you could learn from doing those initial sales that you can then leverage as you expand your product line. But I oftentimes think people do way too much. One book I recommend time and time again is Essentialism. And my theory is that the future leaders and the people who are going to be most successful in the next generation are going to be those who can focus. Because we are now in the information age where there is constant information and FOMO, right? Every time I go on Instagram, I'm like, I thought I was doing something. I ain't doing nothing, right? I need to get back, right? What am I doing? And it's just this constant barrage of insecurity. And I really think that if people are gathering a theme of what Carla, myself, and Melissa are saying, it's really about like, stop, like just take a breath, stop. Who are you? What are you up into? What are you up to in this lifetime? How much money do you want to make? And what is the best avenue to get there, right? I think we overcomplicate it because oftentimes we're moving too fast and trying to keep up with the Joneses instead of creating a customized path for us and our personal goals.
Yep. Amen.
Would you still allocate a salary to yourself if you're a sole proprietor?
Absolutely. I mean, I think this idea of whether it's salary or a draw, put it in there. If you want to be able to run this business, there is no one out there that's going to tell you you don't deserve to get paid. Now, I think to Carla's point, though, it can't be $1 million just because you think that's what everybody else makes. And again, echoing what Mandela said, this is not about keeping up with the Joneses or the Parkers. It is about understanding what did you make before, calibrating that with the charts, being realistic. What do you need to make on a monthly basis, and put it in there. Even if you don't get to take it every single month, I cannot reemphasize put it in there so that it's in the statements and it's actually reflecting the true cost of running your business. One of the challenges I find, another reason why we get pushed off the cap table, is that we don't put in all the expenses we actually have spent, including salary, and we go raise money we haven't raised enough. Right? Research I did 2 years ago said it costs $250,000 more for a Black entrepreneur to start the same exact business as their white peer, because of many of the issues that Mandela and Carla mentioned in terms of how we start, economic disparity, and the like. And so we have got to get ourselves back on track and accurately capture and monitor what we're worth, even if we miss it. So at some point in time, we can indeed be redeemed for what we've already put into this business.
Mm-hmm. One or two last quick questions. What are your thoughts on choosing to be an S Corp or a C Corp?
I'll just say the C Corp is pretty standard. Incorporating in Delaware, pretty standard if you're going the venture capital route.
Yeah. I would say the S Corp, you can do it, but I would say, even if you're going to get angels or looking at some loans, I think there's some issues around shares and control that I would say at minimum, I would say LLC. I don't really see too many S Corps anymore. And then I think if you're really going on the investment path, then look for a C Corp.
Carla, did you have something you want to say?
No, I said agreed. No.
Oh, okay, cool. So last question, if you could leave the founders and small business owners here today with one piece of financial advice, another lightning round, what would it be? Carla, we'll start with you.
Understand your needs and your wants and think about how much it might take to start and run your business for a year, and think seriously about saving that before you start.
Mandela?
Money is an agreement. It's a social construct. It's literally just an agreement between human beings about what value we think we're worth for the service or product we're providing. It's like cotton and linen and metals, like it's nothing scary. And I think that one of the biggest things that has helped me was transform how I see money, not as something that I'm intimidated by or I'm not sure if I can manage, to something that's a tool. It's a tool for me to go forth and be all I can be, help as many people as I want to help, fund whatever politicians I support, right? It's a tool. And I really think that shifting your relationship with how you see money is absolutely critical to building a successful business.
Yeah.
Melissa,
I will double up on that and then say, one, if you can't track it, you can't claim it. And so keep your numbers in order. I don't care if you're using a composition book or Excel or Quicken or something else, but you got to keep track, even if it's scary and it doesn't look good and it has a negative in front of it. You got to keep track. Otherwise, you're making decisions in a complete vacuum. The other thing I would say, just to really echo what Mandela says, I have 6 kids, and so I tell them all the time, your value is not defined by your wealth. And so we do have to understand that, again, let me remind you, 2 + 2 is always 4. I don't care what's happening in the world. That's not going to change. So it's probably the easiest thing once you wrap your mind around it and know that if your bank account has $5, that does not define your value to yourself or to the world, and be able to separate the two so that you do not get imposter syndrome falsely, that you do not undervalue yourself and your business, and that you're able to just ultimately enjoy. I mean, I think the beauty about all of us, and hopefully what people are seeing, is we actually really enjoy what we do. And this should not be something that is overwhelming and depressing, but something that we really enjoy and find our pleasure and fulfillment for ourselves personally and for our businesses.
Awesome. Well, I think we'll close out on that. Wow. Thank you again to our phenomenal panelists for such an engaging discussion and asking to the audience for such wonderful and thoughtful questions. I want to provide you all with a few important details before the event ends. You will see a poll in Slido with a few questions. If you can please take that before you leave. And as a reminder, you can select the Join the Conversation button at the bottom of your screen by visiting slido.com and entering #Forbes Small Business. In the next few days, you will see some emails from our team, including a post-event survey. We would love your feedback on this event and would love to learn what else you'd like to hear from us in the coming months. You should also pay attention to your email because we have more events before the end of the year. On December 8th, we're going to talk about the supply chain. And on December 10th, we're going to discuss what's next for restaurants. We do hope that you can make one of these events. Thank you all so much. And thanks again to our great panelists and our partnership at Square. Have a great afternoon.
Thank you.
Thank you.